Hello, everybody, and welcome to the show today. Had a little bit of a technical glitch, so the scheduled webinar we had right now had to go away, and I had to restart this one, but hopefully everybody was able to find us okay here on this YouTube Live. So today we're going to be diving in. We're going to be talking about how to get a business loan, even when you think there's no way for you to actually qualify for a business loan. We're going to talk about many different options that can work for you. Now, for those of you that don't know me, my name is Ty Crandall. I'm actually the CEO here at Credit Suite, and at Credit Suite, this is what we do. We help businesses improve their fundability to become more lendable. We also help build business credit and help connect business owners with loans and credit lines. Today, we're going to talk about a lot of the options that are out there for business owners that you may just not know about. And if you want to see all the funding you can qualify for, feel free to go to creditsuite.com/get funding so we can get you approved, or feel free to give us a ring at 877-600-2487. So conventional banks have really strict qualifications. First of all, when you hear the term conventional banks, we are basically talking about the big banks. We're talking about Chase. We're talking about Bank of America. We're talking about Regions. We're talking about all Wells Fargo. These are banks that are government insured. Okay, they're not a good place to go look for startup loans or if you have poor personal credit. Now, don't get me wrong. I was just talking to a friend of mine where all he does is SBA loans, and we're rolling in a lot of those products to help our clients be able to get the long-term low interest rate loans. But depending on where you are in your business, if you don't have 3 years worth of tax returns, if you don't have good personal credit, these banks are just not the place to go. They're not going to help you with credit issues. They're not going to help you if you have startup loans. Usually they're going to want 2 to 3 years worth of tax returns. It's almost always 3 years worth of tax returns. So that means if you're thinking about walking into a big bank, you're just wasting your time unless you've been in business realistically 3 years or more. Okay, now if you're lucky, you might get a single credit card, and that's something that banks can issue without going through SBA. So the important thing to know is that conventional bank loans are SBA loans. Think about the way that this works. Big banks like Chase are government insured. The government requires they be very conservative with their risk. Let me turn my volume a little. They be very conservative with their risk. So as a result, they just can't lend to businesses the way that they maybe would like to, because lending to businesses is inherently risky because of business loan default rates and business failure rates. So as a result, what happens is when you go into a bank, the only type of loan they're really offering to businesses is small business loans, SBA loans, because SBA insures the loan up to 90% in case of default. That means if you default on the loan, 9 out of $10 you borrowed, SBA gives back to the bank. Bank can't lose then, right? If they give you a $100,000 loan and then $90,000 gets paid back to them in case you default, they don't lose. So because the SBA insures these loans, that's the loans that the banks that deal with very conservative risk are even able to offer you. Now, credit cards are issued and backed by them, the bank. They're not issued by SBA. So it's easier to get credit cards, a single credit card from a big bank, than you're ever going to find when it actually comes into getting credit lines or loans. Over 89% of business applications by these big banks are denied. And if you heard our Facebook Live last week, where we talked about Small Business Financial Exchange, or 2 weeks ago, you should go back. Go to facebook.com/Credit Suite and look at that, because that live, we decode how this whole thing works, what happens behind the scenes. And the reason a lot of these applications are denied doesn't have to do with you not qualifying. It has to do with the fact that information they're looking at on your application doesn't match the stuff they're getting from other databases like the Small Business Finance Exchange. They're concerned of fraud. They're denying the application. So there's a lot of reasons that you can get loans denied, but we're going to talk about how to overcome that. The biggest and most important thing to know is that these big banks are not the place to go unless you're very well established. So what do lenders want to see? Well, lenders generally are looking to see these things. One, enough assets in some cases. Assets are referred as collateral. So most financing that's unsecure, like credit cards or loans that don't need collateral to qualify, those are ones that you can qualify for. So some of them you have to have assets for, like collateral or asset-based loan programs. Some of them that are unsecured, you don't need assets, but that will determine whether you need assets or not, the type of loan program you're looking at. Sufficient financial reserves. Okay, bottom line, number one thing lenders are always looking for is very simple. Can you pay back the loan? That's it. That's all they really care about. Can you pay back the loan? If you look at every requirement a bank has, it all comes down to that one factor, including, do you have assets? Do you have financial reserves? Do you have collateral, which is pretty equivalent to assets, to ride out business fluctuation? Bottom line is, things are great when the economy's great. But with the economy crash, would you have enough reserves, assets, income coming in to be able to still cover that debt? Okay, so how do loan applications demonstrate these things? Well, borrowers got to show solid cash flow sufficient to repay the loan. Now, here's the problem. With big conventional bank loans, with SBA loans, they want to see a balance sheet. They want to see a profit and loss statement. They want to see personal and business tax returns. They want to see personal and business bank statements. So there's a lot of verification of cash flow. Some of the financing we're going to talk about today will just look at your bank statement. Some of them will electronically look at your bank statement, so you don't even have to supply the bank statement. But cash flow is something that a lot of these lenders will look at. We'll talk about lenders that look at things other than cash flow. A track record of profitability. Again, what they're looking for, especially the big banks, is they want to make sure you're growing year after year, and they want to make sure you show profits. So I told you I just got off the phone with a friend of mine who does SBA loans, and this was one of the things we were talking about with the client that we were discussing. The number one question he said is, do they have tax returns that show a profit? If the answer was no, they can't get a loan. If the answer is yes, they can get a loan. In our world of business financing, if you want the longest term, lowest interest rate financing, you have to show a profit. And I cannot be clear enough, as we are in November, almost into December as I film this, and you're about to write off and spend all the money you have to show no money, to pay no taxes, that if you show $5,000 in profit versus $5,000 in loss, in our world, the business financing world, it's a night and day difference. The company that shows profits has a significantly better chance of getting long-term low-rate financing, and the ones that doesn't pretty much has no chance. So profitability on tax returns is what the big banks are looking for. Success in a similar business endeavor. They want to make sure you have the experience or knowledge to do what you're doing, and if not, that you've succeeded in other endeavors in the past you've been at. Now, again, these are all things the big banks are looking at. We're going to talk about options that don't look at all these. Essentially, can you prove creditworthiness? Can you repay that loan? So again, conventional loans are hard to get because SBA loans are what you're getting through the big bank. And SBA evaluates all aspect of the business and the owner, and so does the bank. So when you go into a big bank, the reason SBA loans are so hard to get is that you have to qualify with SBA and the bank, 2 qualifications. They all have different requirements. So for example, I was just talking to my buddy and I said, hey, look, one of my contacts from Wells Fargo said that all their loans that they're getting have to have the house secured as collateral, the business owner's home. He laughed. He said, no. He goes, that depends on the bank. He goes, I send these to banks all the time, and none of them have requested the home as being used as collateral. So again, banks are different here. The bank's qualification criteria is on top of SBA. It's 2 layers. You have to qualify for SBA and the bank. And in that example I just gave you, some banks may say something completely different. You need to use your house as collateral. I don't own a home. Can't get approved. The next bank offers an SBA loan. They go, I don't have that requirement. No problem. So again, what it really comes down to is you've got double qualification with these loans. To get approved, all aspects of the business and personal have to be good. This is the other issue with getting big bank loans. Look, so many people believe they can't get financing. And they're right. They can't get financing at a bank. But it doesn't mean you can't get financing through all these other places we're going to talk about. What's the difference? The difference is this. The bank and SBA look at the whole picture. They look at you. They look at the business. They look at the business's financials. They look at your financials. They look at the business's credit. They look at your credit. They look at everything. And the fact that everything is going to be really good or perfect is really hard to do unless you're very well established and earning millions of dollars. And if you are, SBA is probably a perfect fit. But if you're not, then SBA is not a perfect fit, because as you're growing the business, more than likely you've got credit issues because you're sacrificing your own credit to grow the business. The business hasn't built business credit a lot. You might not show the profits because you're trying to save from paying the taxes. But as your business grows, you naturally and organically become a better fit for these kind of loans. And again, poor personal credit, short time in business, this just makes these things impossible. Going into a big bank with credit issues, no business credit, cash flow problems, no profits on the tax returns, that's completely the wrong place for this kind of scenario. So private investors also can be problematic. And a lot of people see shows like Shark Tank or The Profit with Marcus Lemonis and say, hey, that's what I want. I want an investor. I want an investor to put money in. I was just at a conference a few weeks ago called the Pitch Tank, where all it was investors being pitched to by business owners. But the problem is that private investors or lenders, they want to see 2-3 years tax returns to be able to get money. Okay, venture capitalists is not an option because, again, if you don't have a truly groundbreaking product or idea, they don't want to help you. If you do, it's a good source. Venture capital, angel investors, these guys seek out really high risk financing because they're looking for really high returns. But high risk means something that's just out there. It's a crazy concept, right? It's an Uber where all of a sudden you're going to make a whole business using other people's vehicles. It's an Airbnb where you're making an entire business using other people's homes. It's all this groundbreaking, different things that could absolutely be disruptive in the world that they're in. So if you don't have something like that, if you're flipping homes, there's nothing unique about that. There's nothing different about you than all the other home flippers. So you're not going to go out and get venture capital, angel investing, those type of things. Again, those guys want to see that they're going to be able to exit in 3 years and make millions. Most businesses aren't going to grow to that point in a few years unless they have a really groundbreaking concept where all they need is money to take it to a next level. Okay. And of course, private investors also want ownership in the business. So there are a lot of loans startups and other businesses can get, even if you normally can't qualify. Why is this possible? Because these other loans, this is what happened when the economy really crashed and the government came out with Dodd-Frank and all these restrictions. Lenders were forced to pull back. They were forced to conserve their guidelines became more conservative. It was harder to qualify. The studies I saw on that showed that the actual money being lent in the revolving market decreased by over 20% when all this happened. So now the government's pulling back, SBA, the big banks, everybody's pulling back. Well, whenever anybody like that pulls back, then it allows for opportunity for new sources to come into the market. And this is what's happened over the last 10, 15 years. We've started to see all these new loan programs pop up that use technology, that use artificial intelligence, that only look at a strength of the business, not the business overall, and create all these new options that never existed a decade or so ago. Instead of looking at the entire business to qualify, they look at one single aspect of the business and use one and only one aspect of the business to qualify. Okay, so that is the difference on how you can qualify for this financing and not others. Okay, but you got to keep in mind, it's not coming from the banks. It's not coming from conventional lenders. Now it's 25, 50 grand, 100 grand initial funding. In a lot of cases, you can get up to $500,000 with the kind of funding I'm going to talk to you about. You want more than $500,000? Well, it becomes tough without tax returns, without profit and loss statements, without good credit. $500,000 plus is hard to get, but you can get the $500,000 and below even when you're not getting money from the banks, even when you don't have a perfect business. So let's talk about some startup loans. So this is where you get specialized financing to buy the things you need to get your business started, right? You get loans to put up commercial signs, or equipment financing and leasing is available. So you have to keep in mind that you don't want to just go get a general loan for everything you may need. It's hard to do. Startups and challenge credit. This is one of the biggest mistakes I see business owners make. Probably mistake number 2. The biggest mistake I see business owners make is using their personal credit to try to fund their business, and then it's too late for them to turn it around when they realize it cost a lot more than they anticipated initially. But this mistake is another, probably the second biggest, which is that a business owner comes in and goes, I need 50 grand. I need a loan for 50 grand. What do you need 50 grand for? I need 10 grand for payroll. I need 10 grand for equipment. I need 10 grand for office supplies. You don't ever want to lump everything you need into one sum of money and go look at that one sum of money, because it's hard to get a bank to give you the 50 grand, but it's easier to get equipment for financing for 10 grand and a Staples credit card for the other 10. So first of all, what specialized kind of financing may you need? Do you need a signage for your buildings? Do you need wraps for your cars? There's specialized financing specifically for that purpose. Do you need to get a big piece of equipment? There's equipment financing. There's equipment leasing to be able to get that equipment that you need. Okay. So vehicle wraps, commercial signage, equipment. Another one is commercial vehicle financing. So those are all specialty type of financing that can help you. There's inventory finance that can help you buy the inventory you need. That's specialized financing to just buy something you need to start and grow the business, where you don't need to get a loan to that you use part of it to get the equipment. Use equipment financing or leasing to get the equipment. That leaves the rest of that loan available for other things that you really need. There's collateral-based loans. Okay, so collateral-based loans make sense because you're offsetting the lender's risk with collateral. If you default, then they have something they could take in return. You're basically using your assets as collateral. In a lot of cases, rates are less than 5%. My buddy I just talked to you about, that I was talking with SBA loans, he was saying SBA loans are about 8% right now. This kind of financing is 2 to 5% interest. It's super cheap. It's super affordable. All you need to qualify is you need some kind of collateral. You need some kind of asset to qualify. Revenue doesn't matter. Your cash flow doesn't matter. And that's why it works for startups. Understand that when somebody ever tells you that startup loan, you can get a startup loan, a startup credit line, all that means, startup financing, all it means really is one thing. You don't have to show revenue. That's why it works for startup. So anytime you see the word startup financing, even if you're not a startup, you should recognize that as meaning no doc financing. That's what startup financing is. It's no doc. You don't need doc. You don't need bank statements. You don't need tax returns. They're not verifying revenue. So these kind of loans don't verify credit or cash flow for approval. Now, there's a lot of type of collateral you can use. Stocks, bonds, 401ks, IRAs, existing inventory, account receivables. So looking at this list, for example, stocks, bonds, 401ks, IRAs, those may be things you have. They may be things that people around you have that they'll pledge as collateral for you to start the business or grow the business. Look, statistically, 75% of business owners get money from family and friends. But it's much easier to go to dad and say, Dad, can I pledge your stocks as collateral? It only matters to you if I don't pay the bill. Then it's easier to get 20 grand from dad that way than to go to dad and go, hey, Dad, can I get 20,000 in cash to start the business? And the only way you're going to lose the money is if I default or the business doesn't grow over many years. How many years is it really going to take dad to get his $20,000 back from you? But dad loses nothing if he pledges his stocks unless you default, then he loses the stocks. So it's easier to get people to pledge stocks, bonds, 401ks, IRAs, these type of things as collateral to help you get financing than it is to hit them up for cash. So even if you don't have those things, something to consider. Account receivables, this is where you let your customers pay you over time. And this is the most valuable asset a business has. This is the number one asset used to qualify for SBA loans. So if you're not letting your customers pay you over payments, you should. First of all, if you're dealing with business customers, then you should consider reporting information to the business credit reporting agencies. Okay. And again, if you go to if you email us, info@creditsuite.com, we could probably get you more information on that. I'm not sure the exact link we have to actually report items to the reporting agencies, but we have a whole guide on that. So again, you can let your people pay you on payments, even report their credit to the business credit reporting agencies, helping them build business credit. It gives you a huge advantage over your competitors and helps you stand out. And at the same time, you're making it easier for your paid customers to pay you. And with AR financing, you can get all that money advanced to you in 24 hours anyways, and have assets to qualify for loans in the future like SBA loans. So account receivables is a great way to go. You can work with a guarantor. Ask family or friends if they have these kind of assets, as we talked about. They can basically leverage those in exchange for something else. You may go to dad and say, Dad, I got a great idea for a business. Here's my idea. Dad's like, dude, that's an amazing idea for a business. If I was younger, I'd jump in and help you and say, well, look, you're maybe too young. You may not want to jump in and do the effort, but you've got stocks. I need 20 grand to get the thing off the ground. So why don't you let me tap into your 20 grand? We'll set up a system where you could verify making the payments so you don't have to lose your stocks, and I'll give you 10% ownership in the business. So again, you're basically finding your own venture capitalist, your own angel investor. And just so you know, most angel investing comes from people you know. Okay. Those are affiliated angels. They know you, you know them. unaffiliated or where you're going to get money from investors. The majority of angel lending comes from affiliated investors, people you already know. So again, being able to give up a percentage of equity in the business, interest on top of what you borrow, whatever, gives them a financial reward. Keep in mind, there's this whole new wave happening in the United States right now, where what's happening is they're finding ways for people that want to invest money to be able to invest in privately owned companies. It's flippin' brilliant. Now, we all know the stock market. We're used to investing into publicly traded companies, but the whole new wave is that you now have the ability through peer-to-peer lending, through all these other options, you now have the ability for people to invest in private companies. Why? Because the rate of return on business is so much higher than the stock market. That's what all the numbers show. If you invest in the right business that's growing, that business growth and your return on your money can be substantially higher than you can get elsewhere at places like the stock market. So again, letting people earn interest, letting people get a percentage of your business and return for being a guarantor of these kind of assets makes a bunch of sense. And usually you're going to pay a lot less to these kind of people than you ever would with a VC. Now, 401k financing is the most typical kind of financing that works here, meaning when we look at the number one asset that guarantors contribute to the growth of a business, it is 401ks. So that's a great place to start because a lot of people actually have them. So as we talk about 401k financing, again, that's just using a 401k as collateral for financing. There's no tax penalties. It's based on IRS proven strategies. And again, you can still get a return on the 401k and get a credit line or a loan less than 5% and close in 3 weeks. Okay. Plus, somebody can get 100% financing against what's in their 401k, what's rollable. We do these all the time. Okay. One guy I'll never forget, he tried to get 25 grand at his bank. He owned a bar. We ended up getting over 700,000 in financing from 401k financing. His bank wouldn't give him 25 grand. Now that you know what you know from this webinar, that doesn't seem unrealistic. The bank was looking at all factors, credit, revenue, everything. And in this case, all they looked at was his 401k. They didn't look at anything else. So he could easily qualify for a program where he couldn't get financing at his own bank. Okay, now again, and this says up to 200% financing. But that's not really accurate unless you're contributing your own money into the 401k to grow it. So it's 100% of what's already in the 401k. And basically the way this kind of financing works is that the source that sets up the 401k financing sets up a new corporation. Retirement plan is created for that business. Funds are rolled over. It's a rollover. They're rolling it over from your old plan to the new plan. And the new plan basically purchases stock in the corporation and holds it. And the corporation becomes debt-free and cash rich. That's how it works. Boom. All you're really doing with 401k financing really is it's a rollover program. You're just rolling the money from your 401k into a new investment into your actual business, and then you got the cash to invest and use as you see fit. So think of a 401k as this. A 401k is just you investing in other people's businesses. All you're doing is stopping that and directing the money to invest into your own business the same. You can use existing stocks as leverage too. We mentioned this, stocks and bonds. You can get up to 90% of the value of those stocks and bonds using those as collateral and close in 3 weeks as well, and get pretty low rates, under 5%, and you'll get a credit line or you could even get a loan. So again, interest rates that are several percent lower than SBA. Neither one of the ones I just showed you need collateral or need cash flow or credit. Credit and cash flow do not matter. All that matters is that somebody has the asset to pledge as collateral. Account receivable financing, we talked about this. You can now get up to 90% of receivables advanced to you. What does that mean? It means if you have $100,000 in money that's outstanding that your customers owe you, then $90,000 of that $100,000 can go to you right away. 90,000 of that 100,000 can then get to you within 24 hours of those receivables, of the loan getting approved. And in the future, whenever you have a new customer that signs up for that payment plan, the other 10% is then available once that customer pays their invoice. Now, they've got to be in business a year for this. Receivables have to be from another business or a government or the government, usually not from individuals. Low rates, very low rates, less than 5%, depends on how long it takes you to pay back the money. Okay. And again, a lot can take place here. In about 2 to 3 weeks, you can get this closed. So account receivable financing is a great way to go because, again, you can get very low interest rates regardless of credit, regardless of cash flow either. Okay, and if you have purchase orders, you can also use purchase orders and get those filled as well. It's another kind of financing. Now, we talked about inventory financing, using existing inventory as collateral. You can even use this to get inventory. Okay, but you got to have inventory about $500,000 or more. This is not for new businesses that don't plan on doing some major selling. You've got to have some major inventory to make this work. Get approved for a line of credit for 50% of the inventory value, and rates are usually 5 to 15% depending on the type of inventory you're actually using. Okay, so again, very good kind of financing. Now, equipment financing, as we talked about, is where you get financing or you can lease or buy new equipment. Typically, all you're going to need is first and last month's payment. So here's an example. We had a client that came to us. It was a friend of mine that was opening I'm not going to say a physician's office. What they do is they handle all the marketing and all the stuff for physicians, so they don't have to handle it themselves. And they needed like $100,000, and part of it was for equipment. So what we did was we got them a credit line for the $100,000 they needed, but then we also got them equipment financing, and we used the credit line to pay the first and last month's payment of the equipment financing. So it saved them a bunch of money. They wanted to get a $100,000 credit line, and they used $25,000 of that to make sure that they used $25,000 of that to then actually come in and to be able to buy the equipment. But they still kept the $100,000 credit line intact because we got them equipment financing on the side. All they needed from their credit line was first and last month's payments. And rates will vary widely based on risk. 650 type credit score is all that's needed. Sometimes at the 580, somebody can actually come in here and get approved. And the lender undervalues equipment if you're borrowing against it. So there's 3 types of equipment financing you should know about because it'll get confusing. Most people don't break this down for you. Equipment financing. This works for startups. You can get it with 580 credit scores. It works for higher risk. Equipment leasing. Very similar to financing. You got to be in business 1 year or more. Needs better credit. 650 type credit. Equipment sale leaseback. This is where you have existing equipment. You sell it to the lender, then lease it back from them. So that's where you're not getting money to buy equipment or lease it. You're getting equipment you already own and borrowing against that to get physical cash. So 3 different types of financing. When you're doing the equipment sale leaseback, they're going to way underestimate the value of the equipment, way underestimate it. So don't think you have a backhoe that's worth 50 that you're going to get 50. What they're going to do is probably cut that in half and say, okay, the fire sale value to sell it quickly is 25, and we'll give you, 80% of that is how that will work. So expect them to undervalue that equipment, and it's got to be major equipment that you're buying or borrowing against, not small pieces of equipment like computers put together. Here's that equipment sale leaseback. If you already own equipment, use it as collateral to get cash, lease it back. You got to have that one piece of equipment at least, and again, you can close on that within about a few weeks. So investors who want to buy and flip properties can get financing as well. Okay, you have to have cash. Depends on how much of a home you're buying is how much cash you're going to need, but it ain't cheap. 20, 30,000 in cash to put into an escrow account is what you're going to want. And experience, you got to have 2, 3 recent homes you've done. You got to have about a 650 credit score. Everybody wants to flip homes. Everybody does. So these lenders are really skeptical about people that don't have experience. If you've flipped a few properties recently, then you probably have the cash on hand and you have the experience, and you're probably in good shape. But the people, what they're trying to do is prevent people that are starting to flip homes from getting in. You can't get in with no experience and no cash. If you're starting to flip homes, you probably don't have either. So they're trying to exclude newbies. But if you have experience and you're able to come in and do some financing to come in and get the first homes, this is a great kind of financing to use from that point forward. Okay, and you can also get financing to buy a commercial real estate as well. Again, my buddy that does SBA loans, we and I were just talking about this, and he said one of the coolest programs he's working with right now that most people don't even know about is where you could take the existing rent or lease that you're paying in a commercial building, you buy that building, and basically in a lot of cases your payments end up being the same as you renting or leasing, but you physically own the asset of the building. And these are done through SBA loans, and the qualifications fairly simple if you can show that it cash flows. If you can show that the new loan is going to be fairly equivalent to what you're paying in lease or rent already, it's a great solution. And insurance agents can also get book of business financing. This is an industry specific type of financing program that only works for insurance companies that are using their own book of business or buying a book of business from another insurance company or buying another insurance agency in its entirety. Now, there are SBA Startup Microloans. These are a little different than the other loans we talked about. I'll tell you why. Because first of all, these loans are offered directly from SBA. This is SBA, again, guarantees loans. They don't offer them. You don't go to SBA to get loans. You go to a bank to get a loan that's guaranteed by SBA. But SBA also has this 7M program most don't know about. It's microloans up to 35 grand for working capital. And the average loan amount's about 10 grand. Funds come directly from SBA. And you don't need the 3 years tax returns. You don't need to have excellent personal credit. You need to have pretty good credit. And you need to have your existing businesses showing that you can generate some revenue, but you don't have these elaborate qualifications that you have with SBA loans. So cash flow financing is another option. You got to be in business about a year, sometimes 6 months if you have compensating factors. You need about $10,000 a month in revenue, sometimes $5,000 a month in revenue with compensating factors like good bank account management. They'll work with borrowers with poor credit. We've got sources that do not even do credit checks at all, automatic approvals with no credit checks. Okay, and the other lenders that we work with don't even care about credit. We've got them that will go down to 500. We've got them that have no credit score requirements. So how is this possible? You can get up to $500,000 regardless of personal credit. Sounds like a scam. Here's why. Remember what we talked about in the beginning. They're looking at a strength, not the overall picture. In this case, the strength is consistent revenue. What these lenders have been able to figure out with millions of these deals probably funded, I've got to say millions funded, is they've got all these algorithms and all this data to support that if people have revenue, they consistently have more revenue coming in. Their business is growing. The revenue climbs from month to month. They're managing their bank account responsibly. Statistics are great that that person is going to pay back the loan. And the lenders even pull the money right from the bank account. So there's less chance that it will happen where they don't get the loan paid back. So because they have a strength, consistent and good bank account management, they don't care about collateral and they don't care about credit. It's cash flow that they're mainly caring about. So essentially you're using your business cash flow as collateral. Well, in all fairness, this isn't a loan. What you're actually really doing is you're selling your future revenue to a lender for what's called a discounted rate. That's officially in financing terms how this program works. What you need to really know is this. You can get it really fast, 24 to 72 hour funding. You can get it regardless of credit and collateral. You can get up to $500,000. How much you get depends on your current revenue. You're going to get about 12% of your annual revenue advanced to you. If you have $200,000 in revenue, you're going to get about $24,000 in financing, for example. That's about 12% of your annual revenue. That's the basics of what you need to know with this program. The absolute no-brainer, best program out there for people with credit issues. It works really, really, really well, but rates can be really high. So this isn't the kind of financing that you're going to get just to have money laying around to get through a slow season. This is the kind of financing you get for direct reinvestment into the business to grow. So we used this 3 years ago when we got this office. We used one of these advances to get in this office, to hire a business development person, and to do 2 other things, including advertising campaigns. It all worked. Everything we did worked. Revenues skyrocketed, and we basically doubled our sales the next year because we got the money and reinvested into the growth of the business. That's exactly what you're using this kind of funding for. Square and PayPal, love these guys. Both offer loans with no consumer credit check. There's an option when a startup is just starting to become profitable. Okay, so these guys, I like them because about 3 months in, if you're funneling some of your money through PayPal and Square, about 3 months in, these guys start to offer you some pretty good loan programs. Okay, both options depend on sales. Square offers loans from $500 to $100K. Eligibility depends on the sales history with Square. Okay, PayPal offers a maximum loan of about 30% of annual sales. A business can get $5 to $500,000, but you've got to have about 9 months time in business to get their higher amounts. I've seen PayPal and Square 3 to 6 months in business start to hit you up. Look, PayPal actually bought a division of Swift Capital a couple years back. And as a result, we're all getting blown up with their direct mail because that's what Swift Capital did. Swift Capital was one of the pioneers of direct mail marketing for business financing. And so PayPal bought them up, and you see PayPal Loan Builder mail more than likely in your mailbox from time to time. And that's coming because they're aggressively getting into the space. And there's a whole really cool article I just saw about this and about how they're shifting and changing lending. As a matter of fact, I think PayPal now reported themselves as one of the top 5 lenders to businesses in the country. How can they do it? Because think about all the data they have. They have all of your PayPal history, all of your Square history. They can see how much revenue comes in, when revenue comes in, when it's there, when it's not there. They have so much data on you that they're able to use this data and really streamline some pretty good funding options. These are not the loans we offer through Square and PayPal, but I talk about them all the time because I'm such a fan of these loans. You got to go to Square and PayPal direct for these. But again, really good options. I recommend every business owner put part of your sales through PayPal and part of your sales through Square. And here's why. It's easier getting them to accept your payments anyways than merchant accounts. And that money goes right into your bank account anyways. So you can still get revenue lending and everything that looks at your bank account. You still can get all that kind of financing, but you can get this financing easier, faster, and cheaper than a lot of the other kind of financing that's out there. So whatever you're doing, start using Square and PayPal, some of the easiest money you can get when you actually do that. Unsecured business financing, my personal #1 favorite business funding program that exists. Okay, so basically in this, you're basically coming in. This is a little bit different. Okay, so basically, and this is not the best representation. So it says here that you're ultimately using assets as collateral. What you're doing, the asset here is you're using credit to qualify. With unsecured business financing, you need a 680 or higher FICO score of you or a guarantor. You get 0% credit lines. The 0% goes for about 6 to 18 months. You're going to get about 5 times the amount of financing as your highest credit limit account now. If the highest credit card limit you have is 10 grand, you get about 5 times that, which is about 50 grand. Sometimes up to 8 times that, which could be 80 grand. A lot of these accounts, if you have good credit, 680, 700, a lot of the accounts you'll get report to the business credit reporting agencies. You're building business credit at the same time. You can get up to $150,000 in financing as a startup. It's no doc financing and no collateral is required. And you can use your credit or that of a guarantor to qualify. Love this program, even though these details don't really define what it is. Business credit. This is credit that's linked to your EIN, not your SSN. The credit without a personal guarantee or a credit check. Available regardless of consumer credit quality. You can build business credit immediately, even as a start. Look, everybody needs to do this. It's a no-brainer. Why is it a no-brainer? Because like in 60 days, you're getting $10,000 Staple and Amazon credit cards. It's ridiculous. So much of what you need to buy, you could probably get from IKEA. You can get from Office Depot and Staples and Dell and Apple and Amazon and Walmart. Much of what you need to buy, you can get there, right? I got a new standing desk from Amazon that I needed. I got 2 new filing cabinets from Walmart last week. So most of the stuff you're going to buy for an office, you could get from Office Depot and Home Depot or Office Depot and Staples and Apple and Dell and all that stuff. So that's low-hanging fruit. No credit check, no collateral, no cash flow. Any business can get it. You want to start building business credit right away because if you're following the right steps, 60, 90 days in, you start to get high limit accounts at most major stores that you're buying stuff out now. It's easy credit to get, and there's no qualification requirements with cash flow credit collateral. So there's nothing to prevent you from getting approved. You can get this even as a startup, and you can use it to buy most of the stuff you need to fund the business. Then you're not looking for a $50,000 loan. You only need like 10 grand for payroll or whatever. And it's much easier to get that 10 than get the 50. So business credit is something everybody should have. Business credit, of course, you can get through the life of the business. And you don't have to depend on lenders to get it. And if you still want a loan, which you will, well, business credit's going to determine if you're going to get a loan, how much you're going to pay, and the rates and terms you're going to get. It's just the bottom line. Business credit's very important because not only can it help you get money even when you can't get any other kind of money, but you can also get business credit, which helps you make it easier for you to get all the other kinds of money because they're all looking at your business credit quality to determine if you should be approved, rates and terms, and how much you're going to get. As a matter of fact, business credit reports even have a credit limit recommendation on there where they even say how much money you should be lent. So if you want to get the most money, business credit is a fantastic option as well. So let's recap. Conventional banks, loans, a problem. Not a problem if you're a really well-established business with 3 years tax returns and good credit. You don't have 3 years tax returns and good credit, don't walk into a bank. It's not worth your time. Okay, so are private investors. Private investors are going to want tax returns and profitability too. Venture capital on the investor side, angel investors, they could work, but only if you have a truly groundbreaking idea. If it's not something that's really groundbreaking, those guys aren't going to help you either. Okay, instead, get creative with collateral. Okay, cash flow financing is as well. So remember, cash flow financing is based just on the cash flow of the business. Okay, or SBA loans. Remember, SBA has those microloans, that 7M. You don't want an SBA 7A, which is a regular SBA loan unless you're well established, but you do want those microloans. Those can even work for startups. Square and PayPal. Get set up with them, start running payments through them, because they're great ways to go, as well as getting unsecured business financing if you do have good credit. Also build business credit, and don't forget cash flow financing. I did mention earlier, this is one of the easiest and fastest ways to get money, regardless of credit, regardless of cash flow. You can still get approved for that kind of financing, and then you'll never have to depend on lenders again, right? And that's the idea, is that if you're setting this up, if you're getting credit lines, I think of it two ways. You get a loan to invest into the business for growth, not to have money laying around. If you want to have money laying around, then get a credit line. If you have 3 to 6 months in business, go to creditsuite.com/fundbox, FUNDBOX, creditsuite.com/fund, FUNDBOX, fundbox. Great credit line. Okay, you're usually going to get approved for less than 10 grand unless you show good credit and tax returns. But in the initial inquiry, they won't even look at your personal credit. That may change in time, but right now they don't even look at your personal credit. They tap it electronically to your bank statements. And if you manage your bank account responsibly and you've been in business 3 or 6 months, one of the easiest credit lines to get. I love it, love it, love it. We got 6 grand originally. We supplied tax returns and ended up getting 30. We used it. We asked them for more money and they bumped us to 100. We have a $100,000 credit line with no credit check. I doubt you'll be able to show me any other person that's done that through another source. So again, great way to go. If you have 3 to 6 months in business, they won't look at credit, but they do look at responsible bank account management. So we talked about a lot of different programs here, and we also talked about what to stay away from with the conventional banks. So now you know at least, I don't know, 10 to 15 different ways you can get money for your business, even when you think that you may not qualify. And we also talked about what not to do, where not to go to get money as well. So if you want to interested in getting approved, go to creditsuite.com/get funding. Look, we never charge you a dime of money to get financing. Lenders, they charge fees and points, and we negotiate that to even get you the better deal. And we're one of the only sources you're going to find that works with every legitimate type of collateral and cash flow and credit program. So that way it helps you get the absolute most amount of money. And if you have questions along the way, give us a ring, 877-600-2487, info@creditsuite.com. And don't forget, at the top right of our page, creditsuite.com, all kinds of links. You can listen to us on iTunes, listen on the go. You can watch us on YouTube as we go live every Monday or every Tuesday at 1 o'clock. And you can also tune in on Facebook as we go live Wednesday at 4 o'clock, where you can actually answer questions in real time with me as we're doing Blackboard and whiteboard training. And if we can help you, give us a ring, 877-600-2487, info@creditsuite.com, or visit us online at creditsuite.com. Thanks, everybody, for tuning in. Much more to come here. Let me see if I can pull up our schedule here. These are our schedule. They are on our YouTube live, so you can see exactly what we're doing and when we're doing it. We will be doing how to start a business next week, and the week after, how the Small Business Financing Exchange affects your business. This is the one that you're going to want to tune in on if you want any money for your business. Look, the reason that so many loans get turned down and credit cards is because data is being pulled from this place you don't even know exists. We're going to decode, unveil this whole thing, and map it out and show you what lenders see so you can get approved. So that's the schedule of the next 3 weeks. You can also go to YouTube and see that we have months of our live stream scheduled so you can see what's to come. Thanks, everybody. If there's anything we can do to help, reach out and let us know. 877-600-2487. Thanks, everybody. Have a great day.